The psychology behind panic buying and emotional investing, the feeling before the decision. It usually begins quietly, not with logic, not with careful analysis, not with portfolio reviews or fundamental analysis, but with a feeling. A headline flashes across a screen. The S&P 500 drops 400 points. A friend sends a worried message about their position. Market volatility spikes to levels not seen in years. Store shelves begin looking emptier than usual. And suddenly, something changes inside people. A person who normally invests according to a disciplined asset allocation strategy suddenly panics and liquidates 30% of their portfolio. An investor who promised themselves they would stay calm and dollar-cost average suddenly sells everything. And another person sees falling equity markets and recklessly throws money into speculative growth stocks, crypto, meme stocks, penny stocks, out of fear of missing generational gains. The strange part is this. In those moments, almost everyone believes they are acting rationally. That is the power of fear-driven psychology. Panic rarely feels irrational while you are inside it. It feels urgent, necessary, protective, like an emergency. And throughout financial history, panic buying and emotional investing have repeatedly followed the same invisible psychological patterns. Different market crash, same human nervous system. Why financial actors? Panic together. Human beings are social survival organisms. For thousands of years, survival depended on observing group behavior quickly. If everyone ran from danger, you ran too. If food became scarce, you gathered resources immediately. If uncertainty appeared, hesitation could become dangerous. This survival wiring still exists. Modern financial markets may look sophisticated, algorithms, derivatives, quantitative analysis, but the human nervous system underneath remains ancient. This is why fear spreads socially faster than logically. People often do not react to data first. They react to other people reacting. This creates feedback loops. A few institutional investors begin profit-taking in growth stocks. Selling pressure increases. Price momentum turns negative. Retail investors observe the decline. Fear increases. Margin calls force more selling. Circuit breakers halt trading. The VIX spikes. Pension funds rebalance. More selling cascades through the market. Not necessarily because underlying fundamentals changed overnight, but because investors fear future earnings misses and economic deterioration. The expectation creates the behavior. The behavior creates the outcome. Consider March 2020. The S&P 500 fell 34% in 23 days, the fastest bear market in history. Yet no company earnings data suggested the market deserved a 34% haircut overnight. Instead, what happened was a cascade of selling triggered by fear, margin calls, and uncertainty about unknowns. The behavior created the outcome. This phenomenon is deeply connected to herd psychology and what behavioral economists call information cascades. Humans derive emotional safety from group alignment. During uncertainty, acting differently from the crowd feels psychologically uncomfortable. Contrarian positioning, betting against the herd, creates internal cognitive dissonance. Yet even intelligent investors become vulnerable to this social pressure, because fear changes the brain's risk assessment priorities. What fear does to the investor's brain. Under normal market conditions, the brain allocates energy toward long-term planning, patience, and fundamental analysis. But fear changes cognitive processing dramatically. The amygdala, the brain's threat detection center, activates. The prefrontal cortex, responsible for rational deliberation, temporarily quiets. The brain shifts into survival mode. And survival mode prioritizes speed, certainty, immediate control, and risk avoidance at any cost. This creates several dangerous financial behaviors. 1. Time horizon collapse. People stop thinking years ahead. They stop thinking quarters ahead. They begin thinking days ahead, sometimes hours. The long-term investment theses, whether you believe in semiconductor demand growth, or the demographic tailwinds of emerging markets, suddenly feel emotionally irrelevant compared to immediate portfolio safety. This is why investors with 30-year time horizons often abandon sound strategies during crises, not because the strategy changed, not because their retirement timeline moved closer, but because emotional discomfort became intolerable. Studies show that during high volatility periods, investors check their portfolios 5 times more frequently than during calm markets, and each observation amplifies fear. 2. Loss aversion intensifies. Behavioral economists have documented something called loss aversion. Humans feel losses more intensely than gains. Psychologically, losing $10,000 hurts more than gaining $10,000 feels good. The pain-to-pleasure ratio is roughly 2 to 1. During bear market declines, this emotional asymmetry becomes extreme. A 20% portfolio decline creates psychological pain far exceeding the pleasure from a prior 20% gain. People begin making decisions simply to stop emotional pain. Selling a losing position creates temporary psychological relief. The pain stops. The market stops showing you red numbers, even if that selling decision becomes financially harmful over the long term. 3. Control-seeking behavior. During uncertainty, humans crave control. They need to feel they are doing something. Panic buying creates the illusion of preparedness. Emotional investing, selling bonds, buying gold, rotating into defensive sectors, chasing momentum, creates the illusion of strategic action. Both behaviors temporarily reduce anxiety. And that is why people may continue making irrational market timing decisions, even when they intellectually understand the behavior is counterproductive. Emotion overrides analysis. Action feels better than patience, even when patience is the optimal strategy. The 2020 pandemic example and market bifurcation. During global crises, these psychological mechanisms become amplified exponentially. In early 2020, investors witnessed simultaneously equity market crashes, circuit breaker halts, empty shelves, mounting death tolls, lockdowns announced with days' notice, unemployment spikes, credit spread widening, and economic data deteriorating in real time. This combination overloaded emotional regulation systems. Some investors panic-sold near market bottoms, realizing catastrophic portfolio losses they never recovered. The others panic-bought randomized assets, hoping for rapid recovery. Still others bought technology stocks and meme stocks with reckless leverage, reasoning that volatility created outsized upside opportunities. Here is the critical insight. Fear does not always create defensive behavior. Sometimes fear creates reckless behavior. When people feel uncertain about future income, employment, and portfolio stability, they paradoxically become more impulsive financially. Long-term thinking weakens. Time horizons compress. They reason, if my normal strategies are uncertain, why not take outsized risks? This explains why crises often produce simultaneous, seemingly contradictory behaviors. One group hides entirely from risk, moving to cash, selling equities, and moving into cash drag. Or another group desperately searches for salvation through speculative risk, buying options, trading volatile growth stocks, or rotating into cryptocurrencies. Both are emotionally driven responses. Neither is optimal. Emotional investing as market timing failure. One of the biggest misconceptions about investing is that most mistakes come from lack of intelligence or market knowledge. In reality, many investment mistakes come from emotional timing. People buy when optimism feels safest. People sell when fear feels strongest. Unfortunately, markets often punish this emotionally synchronized behavior. When everyone feels euphoric, when CNBC anchors are declaring new market paradigms, when growth stocks with no earnings are reaching valuations of $100 billion, prices are frequently already inflated. Sentiment is stretched. Risk premiums are compressed. Conversely, when everyone feels terrified, when breadth is completely negative, when valuations have reverted to historical lows, prices may already reflect extreme pessimism. The capitulation may be complete. Upside risk may be substantial. This does not mean every market decline should be ignored. Genuine risk exists. Valuations matter. Interest rates matter. Economic fundamentals matter. A 40% correction is more serious than a 5% correction. But emotional intensity alone is not reliable market analysis. The danger is allowing emotion to become your entire investment thesis. I feel afraid, therefore I must sell. That is not investing. That is reacting. The mathematics of panic and compounding loss. Panic becomes financially expensive because recovery mathematics are asymmetrical. This is critical to understand. A 10% portfolio decline requires more than a 10% gain to recover. Mathematically, after a 10% loss, you need an 11.1% gain to get back to break-even. A 20% decline requires a 25% gain to recover. A 30% decline requires a 42.9% gain. A 50% decline requires a 100% gain. You have to double your portfolio to get back to where you started. This is why emotional selling during severe declines can permanently damage long-term compounding. Compounding itself depends heavily on two things. 1. Consistent investment growth over time, and 2. Time itself. Missing the best market days dramatically reduces long-term returns. Studies show if you invested $10,000 in the S&P 500 from 1990 to 2020, you would have $174,000. But if you missed just the 10 best days, which often come immediately after panic lows, your ending balance would be $89,000. Missing those 10 days cut your returns in half. Emotional interruption breaks compounding cycles. That is the hidden danger. Not the volatility itself, but your reaction to volatility. Media, algorithms, and fear amplification. Modern information systems intensify emotional financial behavior. Breaking news cycles reward urgency. Market alert notifications reward panic. Financial media personalities profit from eyeballs during volatility, so they sensationalize downturns. Algorithms on social platforms amplify extreme reactions. Neutral opinion does not generate engagement. The market is crashing, and here is why you should panic, generates clicks, shares, and algorithmic promotion. Fear spreads faster than nuance. This creates distorted perception environments. People begin confusing constant information consumption with useful financial action. But excessive exposure to fear-driven content increases emotional volatility without improving decision-making. And emotional volatility usually damages decision quality. This is why disciplined investors often reduce information consumption during chaotic periods, not because they ignore market reality, but because they protect emotional clarity. They understand noise and information are not the same thing. Warning signs. You are entering panic psychology. There are several warning signs you should watch carefully. These indicate you are shifting from rational analysis to emotional reaction. A warning sign 1. Anxiety-driven decisions. You begin making financial decisions primarily to reduce anxiety immediately, not to improve long-term outcomes, but to stop the emotional discomfort now. You sell to make the red numbers disappear. You buy assets you don't fully understand, hoping for overnight recovery. Warning sign 2. Compulsive monitoring. You constantly refresh portfolio apps, news sites, or market prices looking for emotional reassurance. This compulsive checking never reduces anxiety. It amplifies it. But you cannot stop. This is a classic sign of panic psychology taking control. Warning sign 3. Strategy. Abandonment. You abandon long-term investment plans after short-term emotional shocks. You convinced yourself for years you were a long-term investor with a 30-year horizon. Then a 15% market correction happens and you sell everything. Your strategy did not change. Your emotional tolerance did. Warning, sign 4, narratives of exceptionalism. You suddenly believe this time is completely different without objective analysis. The economy is broken. Inflation will never end. Growth stocks are finished forever. Recession is certain. These declarations feel obvious in real time, but usually they reflect sentiment, not reality. History is littered with, "This time is different, that was wrong." Warning, sign 5, false urgency. You feel intense urgency to act immediately without proper evaluation. Urgency is one of panic's favorite disguises. Good decisions rarely require immediate action. If something feels urgent, ask yourself, would this be urgent if the market did not move today? Proven psychological defenses against panic. Now the important part, how do disciplined investors protect themselves psychologically during uncertainty? Not perfectly, but practically, not by eliminating fear, but by building systems that function despite fear. Create financial systems before stress arrives. Systems outperform emotions, emergency savings, automated investing plans, diversification rules, predetermined rebalancing schedules, predefined allocation targets, 60/40 stocks and bonds, for example. Asset location strategies. These systems reduce emotional decision-making during volatility because they remove decision-making from your hands. Under stress, people rarely rise to their intentions, they fall to their systems. Reduce decision frequency. Constant decision-making increases emotional exhaustion and depletes willpower. Long-term investors often benefit from structured investment schedules instead of emotionally reactive trading. Contribute monthly, rebalance quarterly, review annually. Fewer investment decisions usually means fewer emotional mistakes. Day traders make 100 times more decisions than buy and hold investors. They also underperform significantly. Separate information from stimulation. Not all information is useful. Some content exists primarily to trigger emotional engagement. Financial news networks profit from fear. Market alert apps profit from notifications. Social platforms profit from outrage. Disciplined investors learn to consume slower, higher quality information sources. You do not need real-time market data. You do not need intraday price movements. Calm analysis matters more than emotional intensity. One annual earnings review beats 365 days of panic-driven headlines. Extend your time horizon. Fear compresses time perception. Days feel like emergencies. Weeks feel like existential crises. Long-term thinking expands time perception again. When people zoom out to a 20-year historical perspective, many crises appear differently. Markets, economies, and societies have repeatedly experienced disruptions before: recessions, wars, epidemics, geopolitical shocks, currency crises. Yet long-term investors who remained invested recovered every single time. Perspective reduces emotional distortion. Accept that certainty never fully disappears. Many people panic because they seek total certainty before acting. When will the Fed stop raising rates? When will inflation peak? When will recession hit? They wait for certainty. But certainty does not exist in investing or economics. Emotionally mature investors stop demanding certainty before acting rationally. Instead, they build resilient systems capable of functioning under uncertainty. That mindset changes everything. The identity shift. At some point, financially disciplined people stop seeing themselves as reactors. They become observers. They study their own emotional responses carefully. They recognize fear, greed, urgency, social influence, and anxiety-driven impulses when they appear. Not with shame, but with awareness, because awareness interrupts automatic behavior. Once people understand that markets are partially emotional systems, that prices reflect not just fundamentals but also sentiment, fear, and herd behavior, they stop expecting themselves to feel calm naturally during crises. Instead, they prepare systems that protect them when emotions inevitably appear. That is real financial maturity, not emotional perfection, but emotional awareness. Panic buying and emotional investing are not signs of stupidity. They are signs of human psychology under stress. And understanding that matters, because the greatest financial risks during uncertainty are often not external first. They are internal. Fear, urgency, emotional decision-making, shortened time horizons, the need for immediate relief, the social pressure to act like everyone else. These forces quietly shape economies, markets, and household wealth every day. But people who understand these mechanisms gain something valuable: perspective. And perspective creates space between emotion and action. That space is where better financial decisions are usually made. I subscribe to Sterling Invests for deeper analysis on financial psychology, behavioral investing, market mechanics, and the hidden forces shaping modern wealth. Next week, how to build portfolio resilience before the next